So, welcome back to Chapter 21. We are doing Part D. So, we are looking at prospective application now. And remember, prospective application is for a change in estimate arising from new information, or it could be a change in accounting policy due to new circumstances. You can read the text for information about the method and disclosure. No entry is made to adjust retained earnings because it's just going forward. So, formula for recalculation of straight line depreciation after change in estimate. You learned this in 315. New depreciation expense equals book value at time of change minus new residual, if it is new, if it's old, just old, divided by life remaining. And if you're thinking about double declining, same idea, 2 over the life times book value at time of change. So, same idea. So, let's do an example. Example 5. Oliver Inc. acquired the following assets January 2020. Equipment, estimated useful life 5 years, residual value 15,000. Sorry, there should be a line there. Building, estimated useful life 30 years, no residual value, and here is the cost. So, the equipment was depreciated using double declines for the first 3 years for financial reporting purposes. In 2023, the company decided to change the method of calculating depreciation to the straight line method because, and this is important, a change in the pattern of benefits received. Okay, so that says it's a change in estimate, not a change in accounting policy. And they didn't change the useful life or residual value of the equipment. Also, they're going to change the building's total estimated useful life from 30 to 40 years, no change in the estimated value. The building is depreciated using straight line. So we want to calculate and record depreciation expense for 2023 for the equipment and the building. Ignore taxes because we're not worried about calculating DIT or FIT, and that's back in chapter 18. So prospective stuff, it's not as critical. Okay, so let's start off with our equipment. Now we're switching from double declining to straight line. So we were doing double declining, now we're straight line. We need the book value at the time of change. So we need to figure out what our book value is in 2023. We're bearing in mind we bought it in 2020. So we need to use the double declining method to find what our book value is. So 2014 depreciation is 465,000 times 2/5 is 186,000. 2015 depreciation, remember it's book value times 2 over the life. Book value is 465,000 minus 186 times 2/5, which is 279,000 times 2/5 equals 111,600. I'm leaving room over here for the building. 2014, sorry, I'm using the wrong year. 2020, 2021, 2022 depreciation. Sorry about that, you guys. So this is 2020, 2021. 2022 depreciation, 279 minus 111,600 times 2/5 equals 66,960. So the total accumulated depreciation at the end of 2020 is 186,000 plus 111,600 plus 66,960, which gives us 364,560. So now we can calculate our 2023 depreciation. So 2023 depreciation, oh my goodness, I'm losing my mind here. This is end of 2022. So 2020, 21, 2022. End of 2022. So our 2023 depreciation, and we're going to be following this formula up here. So we need the new book value. So book value is cost minus accumulated depreciation. So cost is 465 minus accumulated depreciation minus the residual value. If it's new, there isn't a change, 15,000. And the life remaining. Well, there were 5 years for the equipment. How many years have gone by? Well, 2020, 21, 22. So minus 3. And that's going to be 42720. So we're going to have debit to depreciation expense of 42720 and credit accumulated depreciation of 42720. And that's the equipment. Okay, so notice here, we're thinking, well, 2023, wouldn't that be 4 years we've used up? We're assuming in 2023, so we decided at the beginning of the year. Because remember, you don't record depreciation until the very end. So think of this as January 1st change when they say in 2023. Hopefully that makes sense. Okay, let's do the building now. So the building. Now remember the building, we're changing the total estimated life from 30 years to 40 years. So again, something's changing and we're using straight line. So we have to know what the book value is at the time of the change. So the building, depreciation for the first 3 years is 780,000 minus 0 divided by 3 times 3 is 78,000, and that's our accumulated depreciation beginning 2023. So now we need the new depreciation for 2023. So following our formula up at the top, we take the book value at the time of change, the 780 minus 70,000. They didn't say anything about a new residual value, so we still take off 0. They could have said, oh, and the residual value will be 5,000. That's okay. So what life is remaining? It started off with 30. Now the total, notice it's the building's total estimated life is 40 now. But we're going to put 40 and how many years on by? 3. So that's going to be 18973 So we're going to depreciation expense 18,973 and credit accumulated depreciation 18,973. And that's how you would adjust prospectively for a change in estimate. So hopefully that made sense. Sorry about the little mess with the dates. And again, you guys, if you got a question, let me know. Okay, I'm going to finish off the part E right now on page 9. So, the error analysis, which are responsible for, that I've written on already, I see, gives a more detailed analysis of errors, and you should read it through the, for the full coverage, read through the appendix. Lots. Sarbanes-Oxley has decreased restatements due to errors, but they still occur. Immaterial errors are not corrected. So when you're looking at this, ask yourself what kind of error, what entries do I need to fix the error, and then how are financial statements to be restated. Self-correcting errors or counterbalancing, like if you get ending inventory 1 year, it'll fix itself by the next year. They fix themselves in 2 years. Then the entries you make depend on whether the books are open or closed, and the information is all summarized in the appendix. Don't try to memorize these rules, especially you guys, since you're doing an open book exam. Just do some examples and try and work through them. If you're correcting errors after the balance sheet date but before the statements have been published, you can adjust them, the accounts themselves. You don't have to adjust retained earnings for that current year. But after the statements have been released, then you do have to adjust retained earnings. And what this says, I'll write it out, and then in real life, you would restate financial statements if material. I'm sure you all know this, but just in case you don't in real life. Now, I suggest you focus the most on parts A to D. There will be questions from part E appendix, but they'll be like a low questions, okay? Now, this looks like a huge order, you guys. All suggested problems, the suggested problems for chapter 21, all the brief exercises and all the exercises. So that's a lot to do. You have limited time, you guys. So just do as many as you can. And they're all on Wiley Plus, so you can practice them there. And you should be good to go for the exam then. And as usual, you guys, I'll be giving you a breakdown of the exam and the topics and all that sometime next week. Okay, so that's chapter 21. I hope you found it less onerous than chapter 20. And yeah, I'll see you in chapter 22. Take care. Bye.